your portfolio may have drifted into riskier territory. If you have invested in a 60-40 portfolio on January 1st of 2023 and you have done no rebalancing, your portfolio as of September 4th, 2025 has likely drifted towards a 70-30. The example on the screen shows this. Now, I would not recommend this specific portfolio for multiple reasons, but for the sake of showing an example of allocation drift, I used IVV and S&P 500 index fund for 60% of the portfolio, and for bonds I used AGG for 40%. So if you've been in set it and forget it mode, or your advisor hasn't rebalanced your account in years, you are likely sitting with a more aggressive portfolio than you realize. As you can see on the example here, that 60-40 is essentially a 70-30 if you have done no rebalancing. And reason number 2, stocks have been on a steady rise now. This reason alone is not always a good excuse to rebalance. The S&P 500 hit an all-time high something like 57 times in 2024, and so far this year has hit an all-time high 21 times. A new height does not mean a new higher isn't around the corner, although our brains tend to want to trick us into thinking otherwise. However, sticking with the S&P 500 for example's sake, from January 1st, 2023 until September 4th, 2025, the index is up over nearly 74%. If I annualize that return, that's 23.6%. Again, this doesn't mean we couldn't see more all-time highs in the near future. But if you are looking for a chance to rebalance or increase the safety in your portfolio, you'd likely be taking profits off the table by selling stocks right now versus the alternative of adding safety after a market decline. And reason number 3, Fed rate cuts are likely coming. You can lock in current yields now. Markets are now pricing in a near certain Fed rate cut at the upcoming September meeting. Things always change and probably will, but right now the sentiment is that rates will be cut throughout the remainder of 2025. That means Treasury, CD, bond rates are likely to fall soon. Now is a great time to lock in these higher yields before they drop. Now, especially for clients in or nearing retirement, I utilize a liability matching approach, meaning I like to use fixed income with maturity dates that match up with a client's income needs. For a while, we've been able to lock in nice rates on treasuries, CDs, bonds, etc. But those rates might start to look less appealing if interest rates drop. To recap, here are 3 reasons to consider adding safety to your portfolio now. Number 1, portfolio drift. Your portfolio may have drifted to be more allocated to equities than you are comfortable with. Number 2, markets have consistently hit all-time highs in 2024 and 2025. This isn't a reason alone to reduce risk, but it's much better for your portfolio to reduce risk when markets have steadily climbed compared to after they have steadily dropped. And number 3, high interest rate environments may not be around for too much longer. If you add safety now and you purchase fixed income with maturity dates, you can lock in higher rates now. If you enjoyed this video, I think you might enjoy this video, Surprising Retirement Spending Trends. Thank you for listening. I'll see you in next week's video. And as always, money is a tool, knowledge is freedom, and planning is power. Have a great rest of your day.